Hey everyone, all you everyday traders out there, welcome to another episode. This is Greg Jensen, CEO of Options Animal. Good to be with you again today, kicking off the beginning of fall season and the kind of the scary time to be in the market. If from a historical standpoint, these
Oh,
next couple weeks may have a little bit of up and down and all over the place, but we'll maybe conquer some ideas of how to trade it today. I'm joined as always by my friend, everyday trader, Eric. How are you?
awesome. Thanks, Greg. Yeah, so that point that you were just discussing, the last 2 weeks, last 10 calendar days of October, I'm sorry, of September are historically the worst trading days, the worst two trading weeks. And we've had a pretty bullish week today. Or actually, I think we were up. Where are we now?
Yeah, we're
We're
still up. We're
flattish.
having a nice move today.
Okay. Yeah, so I guess this morning we were dipped a little bit red on some of the indices, but we've been very strong. So there's window dressing that happens towards the end of the year, plus a lot of other um, calendar sort of quirk things. We were entering the period when stock buybacks, there's a blackout date. So a big part of the reason why some equities go up, you hear Apple's buying their own stock or GM's buying shares. There's a blackout period because we're approaching the next earnings season. They can't buy before the earnings season. So there's that happening. There's tax loss harvesting, which is happening in hedge funds and even individual traders as we approach the end of the year, and then window dressing the end of the quarter. So we tend to see a lot of volatility here. Volatility's been to the upside. Usually it's to the downside. So we'll see how this goes.
Well, our liquidity is hanging in there. I think that's one of the reasons why our markets are able to go through all of the uncertainties. We got our Fed rate cut last week. I know we talked a little bit about that in the OA Weekly that you and I did together last week. The Fed finally cut rates. Um, the liquidity measures that we usually have looked at, measuring excess liquidity, things like the Treasury General account, the reverse repo market over the New York Fed, those are hanging in there at reasonable levels, and I think there's still a lot of um, I hate to use the word cash on the sideline because I think that's a misused term. But there is a lot of cash that has been invested in um, short-term yielding assets that higher interest rates have given us for the last year, a couple years now, that are maybe the futures they're going to be looking for a new home. So I think there's reason to be optimistic right now, um, even though the economy may be slowing. I don't know that it is. Some people are pitching the story that it is. I'm still of the opinion our biggest risk, you and I talked about this on Friday, big picture for the economy right now is actually that the Fed is too easy and too accommodative right now with their monetary policy, and they reignite some inflation issues again. I guess we will see if the deflationary pressures of things like artificial intelligence finally getting implemented, immigration, things like that can cause deflationary pressures on the economy. But right now it seems like we're in Goldilocks land. There's plenty of money to go around, and you just keep chasing Nvidia up the flagpole, right? Is the way to make money.
Yeah, I saw a piece yesterday on the AI thing. I don't know if you saw this. Sam Altman, in a recent interview said we're within thousands of days for AI superintelligence, which he says
What,
that,
that it becomes conscious?
yeah,
So
within,
Terminator, so Skynet then.
yeah.
All
And
right.
then he says if there's anybody who can understand what AI is capable, he says we cannot even imagine what it will be capable of. And so, 360 days a year, that's so 3 years is 1,000. So he's saying 3 to 6 years. We're, probably looking at 2030-ish, sometime around then. Ray Kurzweil wrote an interesting book, and he says 2035 was when we're going to have the singularity, and that's where humans and technology merge. So I don't know if you heard Rogan's position on it. Joe Rogan he thinks that AI is essentially a new life form, and that sees the same sort of thing as us merging with AI. It's interesting. That's not the path that I was going to head down. You throw in Elon Musk's Neuralink,
Well, that's just where I was going to go, is Elon Musk's opinion on AI.
right? Yeah. So I think there's still tons of opportunity in AI. There's no question the semiconductor market. I did see a piece this weekend saying that they're expecting earnings across the AI sector, to be up by 50% next year, earnings to be 50% higher than this year. So I still think there's room to go and grow
I
in some.
still have the heart, and I know you're really optimistic about AI, and I'm not saying that it's not cool, but I have the hardest time seeing the legitimate growth in earnings, other than in this build out phase that we're building all these supercomputers. But how do I make money from it? Is still where I'm not sold on it yet. That it's as revolutionary as the internet was. But call me Paul Krugman, maybe. I don't know.
Well, the reason I'm super bullish on it, I mean, it's the overall GDP. I mean, there's been several analyses that have been these long form thought pieces by like Goldman Sachs and UBS that have, and I think Bank of America has done some, just looking at the overall impact to global GDP through better productivity, so which benefits us in all sorts of ways. Which stock to buy? Uh, I don't know. Buy Nvidia. It's up good today. I don't know. I'm out of Nvidia. I actually was looking at doing a trade today on Nvidia. I didn't pull the ticket yet. Well, it's still not too late, but we'll see. Uh, Actually, I could tell you what not to buy. Or maybe, I don't know, want to get your thoughts. The reason that we wanted to do this episode was there's rumors about acquisition of Intel, that there's rumors that Qualcomm has been in discussions to take over Intel. There's also that broke on Friday, and then over the weekend there was an announcement that Apollo Group has approached them to put billions in. I don't know what that means in Intel. I think Intel really is a company that has a great legacy, but it's a dinosaur, and I think their culture is really getting in their way. But if they do get bought out, there could be opportunity there, and certainly option traders are probably speculating. You can actually see there's a massive spike. Earnings is not until the end of October, and we're looking at implied volatility spiking on Intel right now. So there's a lot of people that are trying to trade options on Intel, and that's what I wanted to talk to you about today. Is your thoughts on what sort of strategies should retail traders be thinking about, or maybe not thinking about? What aren't they
So
thinking about?
before we go all optimistic on trading, I gotta throw out, it's just weird. I know history doesn't repeat itself, but man, it rhymes from time to time. This feels so much like at the end, right when the internet bubble was bursting, when Hewlett Packard bought Compaq. Two dying technology companies trying to keep up with the internet and this new technology that was coming. And these two companies said, let's merge and everything's going to be better for shareholders. And what did it do for HP? They're still around, but that's been dead money for 25 years. It was a
Are you
trade
saying
at the time.
Qualcomm's a dead company?
I do. I think Qualcomm's dead. I think that's why there's reaching out to try to grab Intel right now, in the
Ooh.
hopes that maybe we can keep up with Taiwan Semi and Nvidia and AMD. I think Qualcomm has a lot of amazing, what has kept Qualcomm in business for years. And I'm not the semi expert. Maybe Barry will completely disagree with him. We should get him on again and do another episode. But the bulk of their wealth has come from the patents that they built years and years ago, that they own in the semiconductor space. And as far as a manufacturing company, Qualcomm isn't nearly as dominant as Intel as far as the capacity to make chips. And so I see them maybe looking at their patents, going, the stuff that NVIDIA is making right now is making our patents obsolete. So we got to do something drastic. So let's go try to acquire, which at one point, I don't know if Intel ever did wear the crown of the largest company in the world, but I know they were the top 2 or 3 back in the day when it was Microsoft, Intel, Cisco, and Dell. I think those were the 4, and GE was right there with them. But like I said, I don't know if Intel ever wore the crown, but the idea of Intel being acquired, again, 25 years has passed, but it was unfathomable at the time. It would have been the other way around. The Intel is doing the acquiring, right?
Yeah, your comments made me reminded me of when you remember when United and US Air were going to merge. I don't know, maybe
Yeah.
10 years ago, and then the merger didn't go through, and they both went bankrupt.
Yep.
It's like, yeah. So that's,
And I don't know. Qualcomm's probably in a little better shape than
I mean,
HP.
Qualcomm is, it's a different business. It's not microprocessors, it's modems, and
Yeah.
so I think there's, yeah, I think there's, I don't know. Let's put aside our opinions here on on
And what it means, big picture.
yeah. I mean, let's play out the hypothetical here.
Okay.
So Qualcomm comes through and offers a 20% premium. So wherever the stock is trading, they're going to buy it 20% higher. That's probably, if the deal goes through. We're not saying the deal does go through, but option traders are out there speculating right now that the deal does go through. And they're probably doing things like buying spread trades. Maybe they're buying calls or buying call spreads, or maybe selling puts or selling put spreads. There's a lot of option volume and there's a lot of movement that's happening. You can see it in the option market on Intel, people speculating. I've personally played some of these and actually called them right and have had somewhat disappointing results due to what happens when a company is ultimately acquired. So, I mean, first of all, what happens to the stock price? Let's pick a number. Where's Intel right now is $22. Let's say that they say, okay, we're going to buy it at 28, and you got to put it to the shareholders. Shareholders have to approve it. We need SEC approval and whoever else. What happens to the stock price?
Well, generally is going to go
Does it
up.
go to 28?
Does it go to 28? Yeah. It depends, right? It depends on a lot of things.
And I'm not saying 28 is the price. I'm just picking a number here.
It doesn't right away, but it comes
Right.
close.
Right. And the gap reflects.
Yeah, the gap reflects the uncertainty of whether the deal is actually going to close or not.
Right. Right. So that's the stock
and it's
price.
going to get SEC, or not SEC, but FTC approval.
Right. So put things into perspective. Implied volatility, the 30-day implied volatility index, pre-earnings is usually somewhere around the mid 40s, 46, 45. Maybe it gets as high as 50. Right now it's at 56. So it's not considered pre-earnings yet on this in this index, but we are getting higher than pre-earnings implied volatility. So this means that options are relatively expensive. So there's premium extrinsic value. There's extra extrinsic value in options because there's a lot of people speculating. So the stock price will gap close to 28, and the difference will be a measure of the uncertainty. What happens to options and option pricing?
Well, usually they disappear. At least the premium that you're talking about, the extrinsic value disappears. Because same type of scenario, that extrinsic value is that unknown, that uncertainty of what the future brings. And if all of a sudden there is a proposed buyout price that is going to happen in the future at $28, well, the uncertainty potential of it going to 30 is virtually zero now. The potential of it going to 15 is virtually zero now.
Right.
So all of that fluff price gets sucked back out of the options world. And it's really just intrinsic. Now it's not, like I said, there's just a little bit left, but it's very minimal, if anything at all.
Right. So that, and we talked about the stock price approaching whatever the buyout price, and that difference reflects the uncertainty. And you see the same thing because the implied volatility, it's the extra premium that's in options above the intrinsic value. So, everybody listening to us, if you're trading options, you need to understand what intrinsic value is and what extrinsic value is. So, intrinsic value is the difference between the strike and the current price. So, it's how far in the money is the option, and then the option isn't trading for that price, it's trading for something bigger. It's the extrinsic value is the difference. And all options that are out of the money have zero intrinsic value. Out of the money options have no intrinsic value. So
Just to
100%.
give you a real quick, just today, right now, Intel's at 2276. If you look at the October 25th option chain, the call option is at $22. The $22 strike is bid 201, ask 204. So again, it's only 70 some cents in the money. That's the intrinsic value. All that extra $1.25 or so, that's that extrinsic value that Eric just explained.
Right. So that extra value, and what Greg was saying earlier, is when the acquisition gets announced, that extrinsic value is a reflection of how much uncertainty there is in the price. Like, could it go to 30? Could it go to 15? And that's in the extrinsic value. We can extrapolate what sort of movement does the market expect by looking at the extrinsic value of options. And when the uncertainty drops, when we know that there's going to be an acquisition, we see two things happen. One is the implied volatility is going to drop massively. So you're going to see like a post earnings volatility crush. That's some people who've tried to do a straddle or a strangle over earnings, and you think, oh, I'm going to make money. And you figure out how much the stock moved. And then maybe you look at the move after hours and you say, well, I should make money based on this. And then the market opens the next day and you see that there is a huge deflation in the extrinsic value, i.e., the implied volatility drops. This is called IV crush. And you probably broke even or maybe didn't even make money on that straddle or strangle. So the same thing will happen. This is a fixed event that's coming up that's known. Well, it's speculated right now. We don't know for sure. And it's something that is going to cause more uncertainty. And then when it becomes certain, you'll see intrinsic or extrinsic value drop. Now there's another thing that happens. And Greg mentioned the bid and the ask price. That's a measure of the liquidity. How easy is it to buy and sell an option? What happens to liquidity after the announcement?
Again, it goes away. It virtually almost dries up because there is that certainty out there. Not a lot of people want to trade that option anymore. There's not money in for the market maker to really trade it. And so what he'll do as well is he takes those bid ask spreads that on a company like Intel, pretty actively traded company, usually a pretty tight bid ask spread, like the one I just read to you had it was bid 201, ask 204. That's a pretty tight bid ask spread.
Right.
After the split announcement, after the acquisition price announcement, if a takeover does happen, all of a sudden the bid ask spreads widen drastically. No,
It
you
might
might
go
see that.
to bid $1, ask $6.
Yeah.
I mean, I've seen $5 bid ask spreads on equities in this situation. And you would say, well, wait a minute, how can it be the bid be less than the intrinsic value? It's in the money. Sorry, Charlie. That's just the way it works if you want to trade it, because it's like a vacuum, all the air leaves the room and nobody wants to trade it anymore. So you're going to have a lot of difficulty, those of you that are going to try and do an option spread. When the announcement becomes more certain, it's going to be you'll see a massive volatility crush. And some of you think, well, I'll do a Vega negative trade that benefits from an IV crush. that might be a good trade. But if it's a complex trade, if it's got multiple legs, if it's got longs and shorts on it, you maybe do an iron condor or some sort of credit spread or ratio spread, you can not necessarily count. And this has happened to me where I would have made a lot more money if the liquidity was good, but I couldn't trade the options, and I ended up having to take very unacceptable pricing just to get out of the trade and make, instead of making 100% ROI, maybe I make 10% or 20% ROI and give it up to poor liquidity. So, do you agree? Anything to add on that?
No, well, yeah, it becomes essentially a trade that you can do a trade in anticipation using options. It's not saying you can't, but the hard part about a straight options trade when you're trying to trade an event like this has to do with exiting the trade, as you very well, explained. It's not that it shouldn't, that you can't still make money. You still may make some money, but I think there's better ways to structure a trade so you can potentially still trade the event itself, because
Right.
it is tradable,
Yeah.
especially the speculation side of it.
Right. So
Um,
what happens when the deal is ultimately consummated? It's what happens to all the options.
Well, they'll all get converted ultimately into the new equity. So and a lot of it depends on the devil's in the detail, right?
Right.
If Qualcomm comes in and buys Intel with a combination of stock and cash, well, then there'll be a combination. There'll be some new strike price that will be created
Right.
for that option that you own that's now going to be a Qualcomm option instead of an Intel option. And I can tell you, I've been through acquisitions like that too. They're messy.
Right.
My recommendation, and again, I'm not giving you trading advice, but if I were in a situation like that again, I would not go through the event if that were to happen. I would just say, take my trade off the table, pull it out. So that's what's eventually going to. Now, if it's just an all cash deal, well, that's a different scenario. Then what's going to happen to the options is they'll just eventually disappear. They'll get delisted by the Chicago Board of Options Exchange once the purchase price is fully executed and the cash exchanges hands for shareholders.
One of
And
our, oh, sorry. Oh, I say one of our clients a couple weeks ago reached out to me to ask me. He had a company that he was trading, and they got acquired, and it was a stock and cash deal, and so it was 87 shares for every 100 shares. So he now has options that are worth that are have 87. They're worth 87. They're not 100 shares. They're 87 shares. And so they have a new special symbol, which isn't even listed, and nobody's going to trade it.
right,
So it's those new symbols, unless it's pretty even. Like what you remember when Tesla did a 7-for-1 split, or was it Apple did a 7-for-1 split? They if you had a 700 contract, you got a 7 100 contracts. But sometimes these ones you get some really weird strike numbers. That's why sometimes on an option chain you'll see something that's not a nice round number. It's because of some sort of a split or acquisition or something like that. But if these options are given a special symbol, they're essentially delisted and you can only trade them over the phone. Again, very, very difficult to trade afterwards. And that's, I'm not sure what would happen. It could be cash. It could be they all get converted to Qualcomm shares. But what strategies can you think of that might work?
well, I think there's a couple of different ways, and one of them is you can play the speculation side of it, and do straight option trades. And if you want to do like a straddle strangle, if you want to buy speculative long calls, thinking, well, if I'm going to guess that the price is going to be 25, and you can do research and have an idea and pick a strike price out in time, but that is such a hard game to play. That will get you your highest return on investment for sure if you nail it. But you got a couple of big unknowns. Number one is you don't know the price that's going to get thrown out there. The biggest thing you don't know is you don't know timing. Um, this might be a situation that Intel gets courted for months before a deal finally happens. And then, as you option traders know, one of the key components of your options is the time associated with it. And if you start speculating with call options that you think it's going to happen in the next 30 days, you're going to have a theta start to kick your trade negative relatively quickly, even though implied volatility, Vega might be helping you. If the time passes by too far and it doesn't happen, then you're in trouble. So for me, I think the easiest way to trade it is and that maybe it's a little bit more conservative, but you do it in a combination of owning the equity and then using options to take advantage of what currently exists, like you explained, is that really high level of implied volatility. And I think the best trade for that is an in-the-money covered call, or an out of the money if you want to be a little speculative, but selling call options against stock that you actually own is, I think, probably the best way to do it.
Yeah. So if you did a covered call, it's going to give you a little bit of protection to the downside. And remember, when you sell a call against stock, you're agreeing to sell the stock at that strike price. And why would you do an in the money one? Because there's significant extrinsic value. And I was just looking at a December, if you did December 20 right now, I'm sorry, not December, January. So January 17th, 2025, it's 116 days from today. The trade yields $1.52 on 1849 of risk and capital. So it's an 8.2% return or a 26% annualized return. I mean, it's not, you're not going to get a four banger or a three banger or a two banger or some huge return, but you've got decent protection to the downside. If the deal falls through and Intel drops down, it hasn't been below 1849 for a while. That would be your protection to the downside. It's a very boring trade. And what you'd be relying on when the options, the short options probably will get assigned, and then you'll end up selling your shares and booking it. But I think the thing about people who are looking at maybe spread trades like a bull put, whatever trade you're relying on, it may be the act of assigning or exercising. You exercise long options, you get assigned on short options. That may be what's required for you to make money. And you can choose to exercise a long option. So if you have a long call, you could exercise the long call to acquire shares. Maybe an in the money long call could work. It's a little cheaper. You said a straddle or strangle because in case it goes the other way, my fear of that is a volatility crush. In the case of a short option, you do not have the option of getting assigned, but it probably will happen when the extrinsic value gets lower. Somebody will say, I want those shares so that I can get it converted to Qualcomm or whatever. My point here is to keep it simple, because if you had a bull put or a bull call or something, you're going to have to wait until that short expires, and I mean, it's going to cause you a lot of heartburn and anxiety because there'll be uncertainty as to what's going to happen. You probably won't be able to close the spread for a decent premium afterwards. And so relying on exercising a long call, you're going to acquire shares. If the extrinsic value is nothing, you feel like that's a good deal. So having a long call could work, and I like the idea of the in the money cover call. It's not huge return, or maybe you could do both. So you could do an in the money covered call and use some of that premium maybe to buy an out of the money call. But you got to get really creative here, because your regular sort of strategies, a bull put here or a bull call, those trades you're probably going to find yourself sorely disappointed when you could have made money if it weren't for the volatility crush and the absolutely terrible liquidity.
Yeah. I would say the biggest trade you need to be wary of in these types of strategies is a calendar trade, where you've got a lot of extrinsic value out in the future of your long option, and you think, oh, I'll just sell short-term options against it in a calendar format. But again, when that event becomes known, when there's a price that's thrown out there, all the extrinsic value gets sucked out of the option, both the short-term one and the long-term one. And so you can actually find yourself, you could do a bullish diagonal thinking, oh, and the stock jumps up and goes bullish, and you could actually end up losing money on the trade, significant amounts of money on the trade, because of the unknown happening, or the unknown no longer being unknown, with that longer term long call. So be very cautious don't even try to do calendar trades on Intel right now. It's a very dangerous game.
Yeah. So, and they're Vega positive trades. So they do well when volatility goes up, and we're pretty clear volatility is going to go down. So that's, it doesn't mean just because you know volatility is going to go down that you have to be in a Vega negative trade. That was my first thinking with you and I were talking ahead of time before we hit record. The in the money covered call, I think, is a pretty neat strategy here. People just need to remember that you make the most money when you get assigned on a short call. So people tend to be reluctant and not want to have their shares pulled away and say, oh, maybe I could make more if I could do something with the trade. But I think you look yourself in the eyeballs in a mirror and say, am I okay making 8.2% in 116 days? It's a 26% return on annualized return on capital and your risk. Is that worth doing? The
Yep,
other
every day.
strategy.
Every day of every year of every single minute of the rest of your life.
That's pretty good.
26% a year is a really good return.
It is a very good return. And that, that's pretty significant. I think it's significant. The other strategy, did you mention a married put already?
I didn't yet. I mean, that's another way you can go with this is, again, combining the equity component here. But now instead of selling a call option, you buy a put option, with the idea of, I want to make more than just the covered call premium. I want to make the potential of the stock gapping up big. Maybe the price isn't going to be $28. Maybe Qualcomm steps in and says, well, I'm going to, we'll offer you 28. And then AMD steps in and says, well, we want to buy them for 32. And then Dell it's not going to happen, by the way, but the bidding wars do happen sometimes. And you could get some speculative action that could actually cause the stock to go from 21, 22, where it's at right now, up to 31 or 32. And if you're doing a covered call right at the money, yeah, you'll take advantage of high levels of implied vol, and that 28% is still a really good return. But if you're like, it'd be great to set up, because I think a fair price for Intel's $30. Well, there's not a lot of money in a $30 covered call right now, even with these high levels of premium. But if you think the stock has a chance of going there, you could buy some downward protection, still buy a protective put with it in case the deal falls apart. That's why you do that. But then you just let the shares make you the money if the upside happens in that case. Another way to trade it, maybe a little more upside potential, probably not as high as a probability of a trade as of you actually making money on it, but another way to play the event as well, and not expose yourself to that volatility crush that can kill these trades.
Yeah. So the point here is we're not trying to provide trading advice to anybody. That's not what we do here. But I think that the two important things to keep in mind on an event like any acquisition, it doesn't have to be. We're just talking about Intel right now as an example, but this is kind of evergreen because it's going to happen again. There'll be other companies that get acquired. You need to plan for two things that are going to happen. There's going to be a massive drop. Well, three things. The stock price will gap close to where we think it's going to get acquired. Implied volatility will drop and liquidity will become terrible.
Yep.
So that's that third one, that liquidity is terrible, is the one that can be a real bugaboo because you think, wow, I could have made money, but you might get out as a break even just because you can't trade it.
Well, hopefully it won't become a Hewlett Packard compact deal.
Oh yeah. So you did open my eyes. I wasn't thinking about that, but you're right. Qualcomm and two dinosaurs buying each other.
Yeah, we'll see. I mean, like I say, I think
What if Nvidia scoops in and buys them?
there you see that, but why would they?
Yeah, why would
They're probably up more in market cap just today than both of those two companies combined.
Then their market cap today?
Yeah, I mean, they're a $3 trillion company.
Wow.
I mean, they're right on that door of 3 trillion again. I mean,
Maybe that's why Jensen sold $700 million worth of stock.
Intel's only 97 billion. I mean, they're tiny.
So he could buy them. That's probably why he sold all those shares. He's going to go buy them himself.
He's going to buy Intel.
That's the headlines, right? He sold $700 million worth of stock.
$700 million of stock today.
Wow.
Yeah,
and the stock was up huge today. So, oh well. Buy NVIDIA. Can't go wrong.
All right, my friend. Good to talk to you today. Hopefully you guys got something out of today. If you did, feel free to ask questions in the below in the question bar. Give us a like and a share out there to some of your friends and family. So thanks, Eric. We'll look forward to seeing you at the next one.
Yeah, there's a YouTube that I watch, a jiu-jitsu YouTube. There's Fallon, I think Fallon Fatone is her last name, is her name. She's a black belt and she's about the size of my daughter Emily.
Oh, okay.
And she beats the crap out of guys like me. She's
Love
really
it.
she takes on guys that are, twice her size, and she just climbs them like a koala and chokes them out. Uh, it's funny. I was watching a video yesterday, and she's choking out a white belt, a new white belt, and he goes, "Don't forget to like and subscribe.
That's
Don't
funny.
forget to like and subscribe." All right, everybody.
Thanks, everybody.
See you later.